Good evening, everyone. My name's Dominic Byrne. I work for a very big company called BlackRock, and I focus on what we call multi-asset funds. So very, very different to the last presentation. What we think about is spreading risk around multiple investments, and we think about risk a lot more than a contrarian investor may think about on a day-to-day. And I think, again, that just echoes the points that the vast variety of investments that you have available to you via the investment trust structure. What I'm going to talk to you today about is the search for income. And what I mean by that is looking for investments around the sphere of global asset classes and trying to find those investments that are offering not only attractive yield, but also understanding why that yield is 3% and that yield's 7%. And what does that mean and what does it offer us within a portfolio context? So we're going to cover a few things. Why is yield so important at the moment? Current market environment, current macroeconomic trends. Why is yield so important? What's going on in markets? Why are yields so low? Why are some yields high and others low? And then we'll do a quick tour of the asset classes. And I'll show you that actually some investments, it's not all about the yield. Actually, some investments are quite nice. They don't have any yield and will never have a yield. And then finally, we'll talk a little bit about some asset allocation insights. Before I do that, I wanted to highlight a slide that we use a lot at BlackRock, and every year we'll continually talk to investors, clients just like yourselves, and ask them what they're doing with their money. Where are they keeping their money? Where are they invested? And actually, you'll see alarmingly that most people aren't invested at all. And this is a global survey, but it's very indicative of the UK. Around about 4,000 of 30,000 people that took this survey were from the UK. And you can see that it doesn't matter what age you are, investors are hoarding cash. Why is that a problem? It's a problem because we live in a very low interest rate world where inflation is higher than the yield that we're going to get sitting on a cash deposit. So you're losing money in what we call real terms. You're not preserving the power of spending. Now that's very important, particularly as you reach retirement, because it's that period then where you need to start thinking about preserving wealth. You're not earning, you're thinking about income, you're thinking about how to maintain that power of spending. So you can see that actually the market environment we're living on, yield is really, really important because you're not getting anything sitting on cash, and you've probably got a lot of cash deposits doing nothing, waiting around. So where do we put that money to work? Well, we could look at the newspapers for guidance around interest rates, but we can see that actually, what are they telling us? So, are we just going to simply wait for interest rates to rise, move ahead of inflation, then we'll be sitting pretty on that cash deposit? Well, let's have a look at the press and see what guidance we can get from them in terms of interest rate rises. In 2014, the Bank of England boss said rates are likely to rise months before wages do. And another paper said the Bank of England points to a 2015 rate rise and blurs its guidance. So it looks like in 2014 the Bank of England is about to raise rates, and suddenly this zero interest rate environment is going to come to an end and things are going to start moving again. Well, if you cut forward to 2016, Sky News tells us that Carney's actually in no hurry to raise rates. So nothing's actually happened. We're not really getting that environment again where rates are rising and things are moving. And if you cut forward again to 2016, first rate hike not until December 2019. So I think what this is telling us is, again, that the British press are pretty bad at predicting interest rate rises, but also that interest rates aren't really moving anywhere soon. So we've got to start thinking about asset classes that can give us some income and stop sitting on all those cash piles if we want to make our money work, for instance, or just think about things outside of simply sitting on cash deposits. And that's why we have this very extreme environment in what we call the search for income. Here we have the Irish 10-year bond, basically what is a standard benchmark interest rate in Ireland. And you can see there that the yield on the Irish bond at the moment is around about 0.8%. It's come down a lot. It's become, and that's really reflecting a reduction in credit risk, a reduction in risk associated to the Irish government. And the search for income is so extreme now that the Irish government are so confident about the state of their economy. They're so confident about rates being low that they've issued what we call a century bond. And this is a 100-year bond that gives you at 2.35%. So for the privilege of lending a government money for 100 years, you're getting 2.35% a year. That is an incredibly low rate for taking on that level of interest rate risk. And you can also get them in Mexico if you want to diversify your interest rate exposure. Now, if we think about what's happened over the last 100 years, I spent 2 days last week in the north of France doing a charity cycle around the Somme. In 1916, the world was a very, very different place, and a lot's happened in 100 years. If you're going to take a lot of that sort of maturity risk, I think you want to be rewarded a little bit more than 2.35% for your risks. And it's just really indicative of how far the search for income has gone. And why is that? Well, the next slide really shows us, and you're probably familiar with these charts. They're basically IMF predictions on global economic growth. And really what we're showing here is that actually 2.35% in a world where the economies are growing 2.5%, 3%, that's not so bad. But I think the critical thing is the engine of growth isn't pushing markets into activity. We're not seeing the push for interest rate hikes. We're not seeing the push for increase in yields because the engine of growth is clearly not there. China's expected growth from the IMF is around about 6%, falling a little bit in 2017. That's the blue bar there. India, you can see 7%, but these economies that were so often the engines of growth in the world aren't there anymore. And actually, speaking to our emerging market expert, if I showed him this slide, he'd laugh at China growing at 6% per year. It's just not feasible for many investors. Many investors just don't think China is going to provide that growth. So really what this slide is saying that it's not actually looking that attractive for yields and income to rise massively throughout asset classes going forward. And that's really what's driving this low interest rate environment. So let's have a look at some of the classic asset classes around and what they're yielding at the moment. I've shaded the equities in blue. Now this is an index. You will have very good fund managers and very strong investment vehicles that might be tilted more to income or tilted more to styles that will offer more than this, but we're just looking at the broad investment index. And you can see there that UK shares actually pretty good, slightly below 4%, higher than inflation. Not a bad dividend play. Emerging markets, for all that risk, you're not getting a great dividend. And global shares, the sort of broad global market, around about just under 3%. I wanted to highlight two things. I think, first of all, if you want to go out and invest outside equities, you can look at fixed income asset classes. But to do that, you have to take on quite a lot of investment risk. So you're looking at things like US high-yield bonds that used to be called junk bonds. They're now, through very smart marketing from my industry, called US high-yield bonds. But effectively, they're giving you exposure to very risky or small-cap companies. And actually, underneath that, you might be getting some industry exposure that you might not be comfortable with. So to get that 8% income, there is quite a lot of risk associated with it. Emerging market bonds and corporate bonds there, sort of middle ground. The one asset class that we haven't spoken about a lot tonight is government bonds. And you could argue that, okay, so I don't want to take loads of risk. I'm not being greedy. I'll just stick with a low-risk asset class. I'll lend money to the UK government. It's actually not a bad asset class, really, from a multi-asset perspective. If we think about what really drives bond market performance, what's good for bonds? Low inflation. We've got low inflation. Supportive central banks. Doesn't look like there's going to be a plethora of interest rates going over the next 3 to 5 years. Reduced supply. There's not an abundance of supply of bonds because central banks are buying most of them. And there's a huge amount of demand. And I think within a global context, particularly in the UK, you can look at countries such as Japan and across the border in Europe where they have negative interest rates. There's clearly shifting global demand for a reasonably well-positioned economy that's delivering positive rates across the yield curve. So there's actually good reason to own bonds as a net investment, but not necessarily for capital growth. So it's not like the type of growth that you're going to get from the managers we've seen earlier, but from a portfolio context, don't dismiss bonds all the time. The other thing that I think we like about bonds within a context of a multi-asset portfolio is they respond pretty well to negative economic surprises. If unemployment rises and the economy is doing pretty badly, it's not a bad environment for bonds, and that's great, particularly if you really like shares and you've got a lot of shares in your portfolio. So they offer what we would call diversification. Clearly, though, there are elements that are bad for bonds, and you should be cognizant that they're not risk-free. They are not a good investment when inflation's rising, when interest rate expectations change. And clearly, we saw actually back in 2013 that they can experience losses if the demand or if the interest rate environment changes pretty abruptly. But at the moment, I think we haven't talked about that asset class a lot tonight. Don't dismiss it just because it's got a low yield. It does have a part to play in a multi-asset portfolio. And the other great thing about bonds is you're not just getting exposure to government entities. You can actually go into the corporate sector and buy the bonds of companies. And here we have a Sterling Corporate Bond Index. Again, sorry, no single stock names here, but we're looking just at the broad corporate bond index. And you can see that actually the yield's not too bad. It's pretty stable. It's around about 4%. It's above current inflation. And actually, when we look at the market and what they think inflation is going to be over the next year or so, it's above that. And it's even above the Bank of England target rate. So in a world where growth is pretty low, in a world where interest rates are potentially pretty stable, actually, let's not get greedy. These aren't too bad investments within the portfolio context. The other thing I'd like to mention about corporate bonds is sort of about the valuation, and this is a very, very straightforward measure. All I'm doing here is looking at yields today in the bars against yields that were available pre-crisis, pre the financial crisis. And you can see actually there's no reason why a lot of investors, ourselves included sometimes, really don't like cash and government bonds, because the yields they offer now compared to the yields they offered years ago are pretty poor. You can see the gap between the spots and the bars has come to quite extreme levels. Whereas if you go across the risk spectrum and into sort of slightly higher risk investments, that bar is closed, and that's because there's been a recent retracement in markets perhaps, and you are getting yields or yields that are similar to those in pre-crisis levels. So you can get value in a very simple term across those asset classes, just simply looking at the yields compared to many years ago. And it's also, if we compare the interest rate environment from now until then, it's very different spread against a risk-free rate. The other thing I wanted to mention was about equities. Now, if I move back, you can see that equities, like bonds, and here we've got the equity earning yield of a number of investment regions, are actually pretty good in nominal terms, and they've also been reasonably stable relative to their pre-crisis levels. They've moved around a bit, but they're pretty good value relative to other asset classes. And here is the sort of thing that we think about when we're looking at equities. We're not just looking at the headline yield level. We're looking at the ability of a manager or an index to grow the dividend yield. And that's really, really important, because inflation's keeping on growing all the time, and the ability for a dividend stream or an income stream to grow in line with inflation is very attractive. And I think this is where, I don't want to get into the active versus passive debate, to be honest with you, but this is where active management can come in, because you can see there that actually there's a reasonably high percentage of the UK equity market that is growing their dividend yields. And so by selecting those names, sounds pretty easy, doesn't it? I mean, there's 3 names there. Lloyd's is one of them, Compass another. We can see that actually if you have the value of stock picking or the value of active management, you can pivot to those stocks that have the potential to grow. And actually, more importantly, avoid some of those areas, such as mining, potentially energy, that aren't increasing dividends, and actually in some cases cutting them. So equities are good for 2 things. I think they have the ability to deliver an attractive headline yield, but also grow that dividend over time. I think it's a very important point, particularly when you're looking at growing your income in line with inflation. So the final slide is, and I apologize for the slightly fuzziness of this slide, but I'll talk over it. This is an investment that has no yield. Now, I'm not going to sit here and tell you how to time the gold market, because you think I'm an idiot and I don't know what I'm talking about, because everyone thinks they can time the gold market and everyone gets it wrong. But what we do in our team is we look at things, what we call sort of fundamentals, themes. Does it make sense to own an investment in a specific environment? And sometimes the stars become quite nicely aligned for an asset class that doesn't offer anything for yield, but it does offer something within the portfolio context. And that was the case really for gold, probably around about the turn of 2015 to 2016. How do you value gold? You can't do it. It doesn't got a yield. There's no sort of measure that you can assign some kind of fundamental analysis to gold. It's driven by things like demand in India for wedding season and other sort of events that everyone sort of talks about with confidence, but it really has very little insight into. But what we did find with gold is it is a very, very strong risk-averse asset in certain environments. If there's weakness in the financial sector, people go into gold because they want to have a real asset, they want to have a tangible asset to hold on to value. Now, whether the end game means that everyone walks away with a big bag of gold, difficult to say, but it is very much a risk-averse fear asset. The other thing that was happening around about that time was negative interest rates. I mentioned it earlier. But if banks are actually charging you money for keeping deposits within the bank, then gold becomes attractive as a store of value. And this is where sort of we can look at asset classes again outside the yield construct to see if they have a part to play if the environment supports it. And so we started adding to gold back at the back end of 2015 in a couple of our portfolios, and it's actually been one of the very few investments that's helped us over a pretty tricky period in markets, and the right-hand side there shows you that. So I think with this slide, I would think about the big picture, think about the things that drive asset class performance, but also think about things in a portfolio context as opposed to just going to the highest yielding asset or going to the asset that has served you well in the past. The other area that I'll talk about very briefly is the area of alternative investments. Now, alternative investments mean a lot of things, but there are opportunities in income for some esoteric asset classes, and they may be areas that aren't available in public markets. And a good example would be residential mortgages, high quality mortgages that are offering yields in excess of 7 to 8%. You may have to give up a little bit of what we would call transparency. You'd have to do a bit more work if you wanted to get a good understanding of where the return premium is going to come from. And you'd also have to give up some liquidity because some of the vehicles aren't easily accessible. But one of the benefits that we find with an investment trust is it allows for greater flexibility into these areas. And I think one critical thing that we talk about a lot when we're investing is at the moment, because we have this low interest rate environment, because we have concerns over global growth, because the engines of growth aren't perhaps as pronounced as they were before, then it will take some more longer-term investment themes and thinking outside the box, if you like, to generate the types of returns you may need on the long term to meet your retirement income objectives or your growth objectives. And so within the trust structure, we have the benefit of accessing such areas. So on that point, I'll sum up and say that low interest rates are probably here to stay. Even if you look at some of the very aggressive expectation for rate rises, we're not looking at 50 to 100 basis points every quarter from here on. We're looking at a reasonably low interest rate environment, probably. So we need to expect, or we need to accept lower returns and lower yields, or we need to sort of perhaps give up some of the transparency or the liquidity that we've been used to over the last 5 years in what has been a very profitable bull market. I'd also argue that low yields don't necessarily mean a bad investment within a portfolio context, and we've seen that through bond markets. Pretty good investment first quarter of this year, pretty good investment for the past 5 to 6 years, despite the headlines telling us that the rates are about to rise. And high yields don't necessarily mean great investment. So when you see that high yield index offering you 8%, have a think about what's driving that return, where the exposures are. So, last bit, a bit obvious from a guy that works for the multi-asset team, we would think that a diversified approach to income makes sense in the environment, and perhaps looking at an approach that has an unconstrained element to it that can look at investments that aren't necessarily the most exciting investments that get the heart pounding, but are actually pretty sensible in what is a pretty tough environment out there. And with that, I'll sum up. Thank you very much.